South Africa's largest private hospital group, Netcare, has reported a 16% increase in first-half profits, boosted by cost cuts and strong performance in its core market. Netcare's diluted headline earnings per share for the 6 months to March climbed to 46.5 cents, compared with 40 cents a year earlier. Netcare said strong performance in South Africa offset weaker results in the UK, which were negatively impacted by the challenging economic environment. Simon, SWOT analysis.
Market cap 20 billion, price earnings 13.6, dividend yield 3.5. Tshepo, let's come to you. We were talking, Kelly, we were talking about debt. Netcare, market cap 20 billion. They got debt on their books around 24 billion, and debt to equity ratios over 50. Are they big enough to carry it? I mean, they've got cash of just over almost 1.2 billion. Are they big enough to carry it, or is this another situation where the debt's raising a flag and it's a red of colour?
I think it is raising a flag. I think in terms of Netcare, it's a leverage on two things. Just it's leverage debt. On top of that, it's leveraged on the UK property market, because when you a hospital and you're buying a hospital offshore, you're buying property, and if we see the UK property market coming back down, I think you'll see them struggle a bit. So in my mind, there's a lot of risks coming through from their leverage position. So that is a red flag, and I think I'd be looking elsewhere within the sector. Yeah.
It's an interesting point that Tshepo mentioned. We've spoken about it before. When you buy into Netcare, you're buying into the health sector, and you're also buying a little bit of property. So you've got exposure to both. What do you make of the results?
Well, of the 24 billion debt, 20 billion is in the UK, and it's ring-fenced, so there's no recourse to South African shareholders. Yeah. Notwithstanding that, the UK did have a tough time with a decrease in self-pay patients, which is also their highest margin business. And because of that, for the first time, the operating profit of the UK operations was actually not as big as the interest expense.
And this is a factor of the UK economy. I mean, we saw GDP minus 0.2. We've got VAT increases. We know that of the recovering economies, they're one of the more fragile. It's not quite a pigs yet, but they're certainly struggling.
Correct. And the healthcare system, the NHS, being government funded, that feeds through into Netcare's subsidiary GHG there as well. Notwithstanding that, when you are buying Netcare, you're buying the South African operations with an option on the UK operations to a large extent. And if they can refinance in October 2013, using the properties that they do have, then I think there's a lot of upside for Netcare.
Tshepo, so I wanted to come. One of the things, and we see it with some of the companies coming across the desk here, really strong BEE credentials, and we often say, particularly if they're in suppliers and the like, it really works. I'm thinking RevServe that came out of Serve and the like, really benefit. Netcare had really good BEE credentials, but I'm not sure that really helps them in their space. I mean, notwithstanding there's charters and the like. As a patient, I don't think I'm looking, and I don't think there's those sort of size of contracts. So in this case, BE is something we can say is not really going to help them as it might do some of the supplier companies.
I'd agree with that. I think you're hardly looking at their BE credentials when you're going in as a patient. So I think this is probably one of the few sectors where it doesn't matter as much. So yeah, I'd agree with that assessment. I think overall, I think Netcare is, I think in my mind it's a bit of a risk right now, and if I'm taking a punt in the sector, I'd probably be looking at life healthcare.
It's also quite interesting, Tshepo. I mean, looking at some of the programs that are in place in the UK, we know there could be white paper reform there. They've got something called the Choose and Book program, the national health system as well, perhaps adding a lot of question marks as to the funding procedures going forward. I mean, we know what's happening with the UK budget there. Based on that as well, those that are holding Netcare, what would you be advising right now? Sure.
I think what you're looking for is probably a sense of, look, I think when you're looking at Netcare and the South African healthcare sector as a whole, it's very well run and very well managed. So I think there's a sense that the UK operations aren't quite as well managed, and I'd be looking at some sort of strategy from management to rejig the UK operations. And I think if you see some sort of light there, then you're probably likely to see some upside.
So diplomatic and words that you use. So not hot.
Not hot.
Okay, Jean Pierre.
Is there a mild? Can I choose?
Yes.
We have a warm withdrawal sometimes.
Yeah, warm then.
Warm.
Yeah.
Okay.
I'm a Tshepo. You mentioned Life Health Group. We talked about them last week.
Yeah.
If I need to buy I was going to say property stock, a healthcare stock, I like health. Netcare, no.
Okay, now it's time for our guests to pick their hot stocks for the week. And Jean Pierre, I think we should start off with you.
Sure. My stock for the week is Naspers. It has a market cap of $22.5 billion. And the majority of that is Tencent, a 35% stake in Tencent, which is the equivalent of the Chinese Facebook, if you want to call it that.
And in fact, bigger, I think, in terms of users.
Yes, I think they've just passed 400 million, which is the Facebook number, so bigger than Facebook in terms of number of users. Their stake in Tencent is about $18 billion worth. They've also got a stake in Mail.ru, which is a listed business in the UK, but does most of the operations in Russia.
They've also got DST, which has...
well, it was DST, and they changed the name to Mail.ru.
Okay,
and
they folded
rolled
into
up,
there.
correct.
And that ultimately has a stake in Facebook.
Yes.
And talk about a listing in that space too.
Yes, when Facebook lists, you'll see the feed through into Mail.ru.
What about Chinese government? I mean, we were talking Naspers a week or so ago, and you know, Tencent is what, about a quarter or a fifth of their earnings, but about 2/3 of their market cap. And Chinese government authority, they could come in one day and
change things.
Change things. I mean, I don't want to say shut it down. That's your risk there.
That is a risk. Look, it also keeps competition away, so that's a benefit.
Yeah.
Fair point.
But in the last quarterly results, you saw that Tencent made a $100 million donation, for instance. You read yesterday that Alibaba's CEO transferred the payments platform to himself out of the company. So there are a few funny things, a few risks abound. But just to finish the Naspers story, so you have $22.5 billion market cap. 17 billion is Tencent, 2 billion is Mail.ru. That leaves 2.5 billion for the rest.
And that's things like DSTV and
Media 24, and that's very cheap.
Okay, Tshepo, your hot stock for the week.
My hot stock for the week is Lewis Group. I think
Tell us why, Tshepo.
I just love furniture.
comfy lounge.
Furniture and chickens, it seems.
I think if you're looking at Lewis, it's a lot more than a furniture store. I think it's almost a micro lender.
Yeah.
It's a mini micro lender that you're getting at a price to book of 2. Relative to a Capitec at a price to book of 4. So I think from that perspective, you start to see the picture around it.
Results out soon, typically a good dividend payer. I think the yield's around 4. Would you look for that dividend to move up again?
I think you're likely to see that. I think when you're looking at this business, it's, if nothing else, it's very solid. Solid management team. What they're able, or have been able to do, is grow credit by 16.7% as per their last numbers in an environment where credit has struggled. And on top of that, they've managed to manage the risk around that credit.
What if the interest rate cycle turns dramatically? Then what?
I think that is a risk. That is a big risk for them. But at the same token, you're looking at credit overall and asking yourself, given what money supply is locally, how likely is it that we're going to get very sharp interest rate increases quickly? And given the state of the economy, I'd probably be looking for credit to come back into the market, and Lewis will benefit from that before you see an uptick. So I think from that perspective, it is a risk, and I think it's a risk across all lenders. But I think Lewis is very well positioned. Their key advantage, I think, over the other players is that as the means of collecting credit. So you're not talking to somebody at a central desk. You're actually talking to the person who sold you the furniture, and I think that's a key advantage.